In this video, I will show you how to determine how much you can qualify for your mortgage. This is a pre-qualification tool tutorial. This tool is actually provided to you by the Government of Canada. So once you get to the website, you're going to go through a few things. The first thing you should do is read through the little preamble here. It explains what a qualification rate is, it explains the stress test. Essentially, the stress test is a way for the government to determine or just kind of have some insurance to make sure you can pay for the mortgage in an increasing rate environment. So if the rates were to go up, you want to make sure that you have the ability to make those payments. Now, this means that you're either going to be qualified based on one of two rates. The first rate is the 5.25%, which is the qualifying rate as of today, which is October 17th, 2021. That's the qualifying rate. That's basically the prescribed rate set by the government. The alternative to this is to use the interest rate on the contract, which is the rate that you've negotiated, plus 2%. Whichever rate is higher, that's the rate they'll use. So if you negotiated 2% for your 5-year fixed mortgage, and so that means it will be a 4% rate that they'll be using to qualify. But that's obviously lower than the 5.25%. So that means they'll use a 5.25% as a qualifying rate. This rate is used for basically every transaction you're going to want to do. A refinance, you want to switch to a new lender, or if you're purchasing a new home. So keep that in mind. So for this scenario, we're going to be using a property value of $400,000. So I did take a quick look at one of the properties on the market here. This is in London, Ontario. $399,999. So we're going to do $1 over the asking price. And what do we see here? A couple of numbers that we want to try to find on the page are the square footage. And we want to also try to find some tax information, but it wasn't here. So I'll show you a way to get around that if they don't provide you with any tax documentation. So what we will do is we put in the property price, your down payment amount. So you can do one of two things. You can either put in a dollar amount, 40,000, or you can put in percentage. Whatever works best for you. It doesn't make a difference. For a lot of people, dollar amount is probably easier because that they already know exactly how much they have saved down as a down payment, right? One thing you want to keep in mind is you want to have about 1.5%, or at least 1.5% as closing costs, right? Just to make sure you have enough money for the taxes, all those other things that come along with the transaction, right? Lawyer costs, what have you. Interest rate. So here we're going to put the qualifying rate in there. So that's 5.25%. Amortization period. So or I should say, if you are putting less than 20% down as a down payment, the maximum amortization period you can have is 25 years. Maximum. If you're putting more than that, then you can go up to 30 years, 35 years, depending on the institution. Some even go up to 40 years today, even in 2021. You can have a longer amortization. It just depends on the nature of the institution, and it depends on the nature of the transaction that you're engaging in. So amortization, again, just to recap, amortization period is the length of time it's going to take you to pay off that mortgage. So 25 years means your payments are scheduled, they're spread out over a 25-year period, and your payments are a combination of interest and principal. It's front-loaded with interest, so as you continue to make your payments, your principal portion of the payment will increase over time. Now, when you're making any additional payments, those additional payments go straight towards the principal. So just to keep that in mind, it helps you pay off the mortgage faster, and it decreases the effective interest on the mortgage overall, right? So the amount of money that you actually end up paying in interest will go down. Term. And payment frequency. So payment frequency, we're going to use monthly for this one. Term, you can have whatever term is comfortable for you. We can go into exactly what kind of term you're going to need later on, but for the purpose of this, we're going to use 5 years, fairly standard. Your gross income, for the purpose of this, we're putting 90,000. Heating costs. So where do we get heating costs from? So heating costs is based on the size of the property. So what we do is there's a couple of different ways of calculating it, depending on the institution that you're going to be using. So what we'll do is we'll grab the size of the property, which I said was 1350. Or is it 1370? Let's double check. 1350. All right, so it's 1350, and then we have some sort of factor that we're going to multiply it by. So with the institution that I'm with, we use 60 cents. So 60 cents per square foot is basically the way we calculate the heating cost, right? So that's just the annual heating cost. So you can either put in an annual amount or a monthly amount. Monthly amount, obviously, you just divide it by 12. So $67.50 per month. Property taxes. So where do you get a property tax from? So we took a look here, and there was no property tax information. So what the institutions will do is they'll use 1% of the value of the property. So 1%. So the annual property tax here would be $4,000. Now, would it always be that high? It probably isn't $4,000 in that area, but it could very well be, right? This is just a number that we're going to use. Now, obviously, if the actual amount is lower, that's a benefit. You just get a hold of the documentation to prove that, and then we're good. Credit card line and lines of credit payment. So when it comes to credit cards and lines of credits, what banks will do is they'll use 3% of your outstanding loan balances, right? So you have $5,000 in credit card payments, or sorry, $5,000 in a credit card balance or a line of credit. They'll do 5,000 times 3%, $150. So now this is your monthly payment. So you just plug that in here. Car payments. Now for other types of loans, so whether it's a car payment, whether it's just a personal loan, any sort of term loan where there's no readvancement of the of a loan, right? It's non-revolving. What they will do is they will just take the payment being made, and that will be the amount that you add here, right? So for car payments, just whatever payment you're making, and other debts, just whatever the payment is. Now, for student loans that are not in repayment, they are calculated in the same way that a credit card or line of credit payment is. So you're using 3% or whatever the rate is that institution has, but typically it's around 3%. So, just to be on the conservative side, use 3%. So 3% of whatever the outstanding balance is. So if you have a $20,000 student loan, that means you're paying, on the application, you're going to be inputting $600 per month. Now, if you are in repayment on your student loan, you just put whatever the repayment amount is. So let's say it's $150 actual. And then once you have all that in there, hit calculate. All right, so let's see, do we qualify? So FCAC, this the government organization, uses a gross debt service ratio of 32% and a total debt service ratio of 40% in this tool as a guideline. You may still qualify for a mortgage even if your GDS and TDS ratios are slightly higher. You would. However, GDS and TDS means that you are increasing the risk of taking on more debt than you can afford. So it has a little stop sign here. So you will likely be denied for a mortgage amount of $371,160 since your GDS ratio is 34.84% and your TDS ratio exceeds 41.5%. I'll tell you right now, as long as your credit is good, it's over 680, you would be able to get approved for this as long as there's no other any other issues, right? You'll most likely be able to get approved, right? Your ratios are fine. So if your credit score is over 680, then we can do ratios of 39% for your GDS and 44% for your TDS. I'll explain exactly what those mean in a moment, but just keep that in mind, right? So when you do hit that calculate button, even though this uses a guideline, a very conservative guideline of 32% and 40%, if your credit score is over 680, you can most likely use 39% for your GDS and 44% for your TDS. Okay, so let's look into why we have, how these numbers actually play out, right? So let's take a look here. So the requested amount of mortgage is $360,000, right? So that means we're putting the $40,000 down. Purchase price is $400,000. again, that's 10%. So because we're putting less than 20% down, that means we need mortgage insurance, right? The mortgage itself is insured through one of three companies: Canada Guarantee, Sagan, or CMHC, right? So that means you have to pay a mortgage insurance premium. So what's the premium for this amount? Because you're putting 10% down, it is 3.1%, right? And you pay that based on the mortgage that's being requested. That gets added to the mortgage. That whole amount gets financed, right? So that decreases that your equity in the property by a fairly significant amount. So just keep that in mind. And so this is the actual payment. What the actual payments are going to be based on. It's going to be based on the 371,160, right? Not the 360, because you're financing this full amount, which is the mortgage being requested plus the premium. So what is the GDS and what is the TDS? So the GDS, gross debt service, represents your housing costs. So that's the mortgage payment. That's the heating cost, that's the property taxes, right? And then this is the ratio of all of this, which added up is 2,612. The ratio of that to your $7,500, and then that's per month, which is your monthly income, gross income, and that equals 3,484. Okay, so what is a TDS? Your TDS, which is the total debt service, is your gross debt service plus any loan repayments that are being made, right? So credit card debts, car payment debts, student debts, right? Whatever other loan payment debts. So that gets added to your gross debt servicing, and that becomes your total debt servicing. And again, it's a ratio between that number and your gross income. So you get 4150, and that's basically it. So that's how you would use this tool, right? You want to keep in mind a few things. Now, this 32-40 ratio recommendation that the government is providing, it's very conservative. Most banks, they're not that conservative, depending on your credit. So the reason why you would use this, you'd use this for a couple of things. You would use this to give you a general sense of if you're on the right path to getting the house that you want, how much income you're going to need to get the house that you want, and if you have a sufficient down payment as well to get the house that you want. So a couple of things you can do to mitigate some of these risks here, or these factors. So if your income is low, you can always consider adding other people to your application, right? You can add other people to your application, and then you can boost your income. That's one thing you can do. A couple other things you can do. So if you have student debts, right, you can put them into repayment, because that will lower the actual amount of monthly payments that you have on the application. Or you can get documentation that will outline what the payment reschedule is, right, or the payment schedule is. So that way you will have actual proof as to what you will be paying, as opposed to using the 3% or the 1.5%, whatever the number is that institution is using. Now, it's not a guarantee that they will accept that documentation, but it is something worth trying if you have a lot of student debt and that repayment is going to really throw you off. One last thing that you can do, one last strategy is when it comes to your credit cards, right? When it comes to some of these outstanding debts, you can pay them down. Now, how would you go about paying them down? You can do a cashback. What is a cashback? A cashback is essentially getting cash up front for a trade-off. What's the trade-off? The trade-off is you have a higher interest rate. So how it works is, I'll explain with a calculator. How it works is you can do a 3% cashback. So 3% based on the total amount of money borrowed. So let's just say $11,134.80, right? So you have a cashback based on this amount. So how it works is your interest rate will increase to pay this, so that now you're going to pay the bank this amount of money over the remainder of the term. The difference is you get this money up front, and then you can pay this back over the remainder of the term through an increased interest rate. So the mortgage itself, the principal, it doesn't increase. The principal amount doesn't increase. You just have a slightly higher interest rate. But the benefit to this is, like, why would you do that is the question, right? Why would you basically take a loan? Because it's a low interest loan. It allows you to purchase the property, right? Because you can now use this money to cover closing costs or to pay down debts, right? So that $11,000, you can now use it to pay off that $5,000 credit card debt. I mean, credit card debt is what, 19% annually? So this is, it's a fraction of that. You can use this to pay that out, right? So that makes sense. Pay it out. You can use that to pay down the car debt, right? You can use it to pay down a lot of things that will now allow you to maybe you pay down this substantially. You can renegotiate the debt. Maybe you can extend the term, right? So that the payments are lower. So little things like that can help you get over the line. So when you do the pre-qualification early, when you do this as a first step, it gives you an idea of where you're standing and what kind of things you need to do in order to get to qualifying. So if you already know that you have issues with your credit, if you have issues with the amount of debts that you have outstanding, okay, well now it's just time to put in strategies to mitigate these risks, and how can you get into the property that you want. So that's really it. If you have any questions, feel free to contact me directly. Write the comments below. Feel free to like, subscribe, and share if this was of any value to you. Trying to be more, trying to provide more value going forward. Anyways, hope this was helpful, and yeah, have a great rest of your day. Peace.